Ready when you are.
Well, welcome to our 16th interview, 16th episode of Ideas and Lives, both a YouTube video interview as well as a podcast. You can find us on any podcast under Ideas and Lives, and you can watch our video interviews going to the episodes section of ideasandlives.org. And today we're pleased to have Dan DiBartolomeo.
DiBartolomeo.
DiBartolomeo with my colleague Zvi Bodie. And take it away, Zvi, and introduce yourself to our listeners.
Will do. Okay. Thank you, Bob, and welcome, Dan. We are extremely pleased that you've agreed to this interview. We know that you are an extremely busy man. So I start off with thanks in my welcome statement. You are the sole proprietor of a company called Northfield Information Systems. Is that the
Information Services?
Services. And could you tell us what the company does and a brief history?
Sure. Just a minor correction. I'm not the sole stockholder. I hold about 94% of the voting stock. A couple of friends from back in college days and early in my career, and a couple of employees own small numbers of shares. But of the voting shares, I think my position as CEO is safe, and that having a supermajority, they can't fire me. The firm has been around since the late 1980s. I started it, and what it was intending to do was to build mathematical models of financial markets, and specifically put those analytical models on what was then the new emerging personal computer hardware. Prior to that point in time, these kind of mathematical models existed, but you had to have big mainframe computers, which were typically only available to universities or research labs. And if you wanted to use them as a financial practitioner, it was very, very expensive. You might spend $100,000 a year in software and a couple of $100,000 a year renting computer time. And so the idea of the company was to take that kind of analytical firepower, if you will, and move it to what was then the new idea of having a small personal computer on your desk. We hope that this would be popular and would make these kind of analytical tools more widely available in the financial services industry.
So make them available, for example, to financial planners who have practices. Is that the idea?
Exactly. Though, if you went back to 1985, this kind of stuff existed, but it might be that if you were a financial advisor, it would cost you $1,000 for a half a minute of computer time in order to run an analysis for a client. And then unless the client was paying you several $1,000s, that wasn't a very practical idea. So the idea was to move these kind of things to the then emerging PC platform, where you could buy a computer for $3,000 or $4,000, stick it on your desk, and use it as much as you wanted.
I see.
So,
and what does your customer base look like now?
Today, some 35 years later, we really have four different customer groups. The first are the traditional asset managers, the Fidelities, the BlackRocks, Vanguard. The second are what I would call.
So these are like individual analysts within these firms?
It depends. Some of the services we provide could be utilized by individual analysts. Others, it would include things like regulatory reporting, which would be done for the organization as a whole. So it really depends on the application. Some of the tools are interactive, would be used by an analyst, but many are sort of large scale. The second client group are what we would call wealth management organizations. And what we think distinguishes those is that typically the clients are private individuals, not institutions. And typically a financial organization would have many, many thousands of these kinds of portfolios, as opposed to maybe a dozen mutual funds that they operate, or a couple of dozen mutual funds. We have one program at the moment in wealth management where I believe it's around 1.7 million separate investment portfolios being analyzed. So it's large scale. The third customer category are what I would call large asset owners. So for example, the wealth funds of sovereign nations, the pension fund of the state of California employees, the federal employees of Canada. So big, typically retirement schemes or wealth organizations associated with a unit of government. Not always, sometimes we get private companies, but generally associated with a unit of government. And then the last grouping within the clients are what we call heavily regulated organizations. And these would be things like insurance companies and commercial banks, where there's a lot of regulatory reporting to various government agencies that regulate how those entities operate. At this point, we have at least one client in, at my last count, 33 countries. So we're pretty spread out around the world.
Wow.
And for a layman, give me some examples of why I would buy. In fact, what do I buy? Why would I buy it?
Well, a layman.
I mean, any of these kinds of clients.
Okay. Well, typically, here's a good example. One of our clients is one of the world's largest sovereign wealth funds. This is essentially the piggy bank of a country. Yes. And this particular country has saved up over its history about $2 trillion. So it's a lot of money. And their organization for managing all that wealth involves thousands of people, many, many, many departments. Each of those departments has its own way of thinking about its area of expertise. It might be, how do we invest in farmland? Or it might be, how do we invest in government bonds of another country? Or, technology stocks. At some point, you have to add it all up into one big portfolio and say, is this the portfolio we want? And how much risk are we taking? And is this planned well? That analysis that occurs at the top of the organization, aggregating all the different departments, all the different kinds of investments from around the world, is done in computer software that we provide and is fed proprietary data that is a sort of mathematical representation of how we think these financial assets behave and what makes them behave the way they do. Things like what types of assets are similar to others and what are different from others. What are liquid versus illiquid, things of that nature.
Mm-hmm. What are, I assume you'd look at how correlated or uncorrelated some of these assets are with each other, that sort of thing.
Exactly. I think not only do we look at that, we try to forecast it. One of the problems with correlation analysis in investing is frequently circumstances arise in the past that we don't think will be repeated in the future. You could take, for example, two companies that have nothing to do with each other, except that both of their CEOs were killed in the same plane crash.
Mm.
If both stocks go down on the same day, historically, they look correlated, but we wouldn't expect that to continue in the future. And so
Right.
Part of our process is to try and understand what historical behavior arises from something which we believe is persistent and will continue into the future, and what happened in the past, it's probably not going to happen again.
So is there some guy or woman that takes your software that's accumulating all the different investment decisions within the organization and runs it and sort of runs some simulations? I'm trying to get at.
Yeah,
it.
there's ways of doing simulations. A lot of it is done in closed form mathematical models. It's just a lot of algebra, a lot of formulas, and you stick in, okay, this is what we have. This is the time horizon we're interested in. Like, we're thinking about the next week, or we're thinking about the next year, or we're thinking about the next decade. And push the button and a bunch of reports spit out. And those reports describe how risky we think the portfolio is, how liquid the portfolio might be, what are the risky positions within the portfolio, how correlated do we think things will be in the future. And again, a lot of that is a function of time horizon. You could imagine during the early pandemic that things got a little crazy and a lot of up and down in the markets. Things have calmed down quite a bit since then. And so one of the things we have to take very much into account is, when we talk about investments, we're always talking about the future. We know what happened in the past. And the question that we have to think about is, how far in the future are we interested in? What's going to happen tomorrow? What's going to happen the next week, the next month, the next year, the next decade? And depending on how we answer that question, the analysis will take on different types of methods and different characteristics.
Let me ask a question about Bob Lerman's family's business. Okay. He is one of 10 children
Mm-hmm.
collectively own a business. I won't mention the name because we don't want free advertising. But it is in the business of steel.
Mhm.
So it's not a financial institution.
Yeah.
However, it certainly has a lot of risk. Okay. Mostly commodity risk, but all sorts of other risks. Now, if they came to you and said, Mr. Northfield, DiBartolomeo,
Mhm.
can you do a contract for us that would help us manage our collective, our collection of risks? What is the answer?
The answer is certainly yes. We've done a number of those over the years. One interesting one, for example, was Homestake, the largest gold mine in the United States, and the oldest gold mine still operating in the United States. In terms of, do we leave gold in the ground because the price might go up? Or how do we hedge it, or things of this nature? Similarly, we've done a gold refinery, power grids. We had an interesting case last year, a family from outside the United States, quite wealthy family. Their collection of 4 companies, they had 4 companies, not one, were all in the same industry. Each of the 4 did business with the other 3. And collectively, they were worth about $8 billion. And the problem was that the generation of family members that had founded these 4 companies were now getting elderly, and there was a concern about, gee, are we liquid enough to pay the estate taxes and all this sort of thing. And you could imagine that a family of that wealth would not only have sort of conventional assets concentrated in a few companies such as it was, but also some unusual things. Oh, we own farmland. We own a private island. One of the spouses had a, vast and highly valuable jewelry collection. So in each case, we had to come up with some way of representing those things in mathematics, in formulas, such that we could say, gee, wow, the jewelry is obviously connected to the price of gold. We could probably look at things like the share prices of chains of jewelry stores like Tiffany's or Kay Jewelers in terms of how people perceive the value of jewelry. So the idea is to take what is unobservable, the value of this jewelry sitting in a safety deposit box somewhere, and represent it in mathematics in a way that is related to things we can observe, like the share price of, well, Tiffany's doesn't trade anymore, but when it did trade, you could observe the share price on the stock exchange going up and down.
Would it be inaccurate to describe your business as risk management?
I would say we're quite a bit broader than that. I think most of the stuff we do on a routine basis is about risk assessment and what you do in response to it. Most people think of risk management as I set some limit on how much risk I'm willing to take. And if conditions change such that I'm taking too much risk, I do something about it. I think what we do is quite a bit broader than that. It's more about the economics of understanding the risks you're taking and making decisions that are economically sensible given the opportunities that those risks afford. You know the old saying, nothing ventured, nothing gained, but you want to do things in a sensible way. So if you understand what risks you're taking and understand what opportunities those provide, then you can make decisions to, take a risk or not, in the same way that a gambler at a poker table, depending on what they have in their hand and what they think other players in the game have in their hands, will or won't, make a bigger bet or a smaller one.
So who go ahead, Sweet.
I was just going to ask if we were to go back in time to 2008, were you worried about the system? Did you foresee that it might,
Problems?
Yeah.
Well, that's an interesting question. If you look, I believe it was April of 2009. My picture is on the cover of Risk magazine because in their view, I had foretold that this was going to happen.
No kidding.
They sent a photographer out and took 1 million pictures. What really happened was, 9 years earlier, in 1999, a client who was involved in the area of what were called collateralized loan obligations, the type of security that got into some trouble in 2008, asked us to look at the way the risks of those securities were being evaluated back in 1999. And what I said at the time, which has been on our website ever since then, in written form, was I think we're okay for now because the rating agencies like Standard & Poor's and Moody's are being very conservative. But we have to be careful because their analytical methods are quite crude. So if they stop being very conservative, this could unravel in a hurry. And that was the 1999 conclusion.
Was that before LTCM? Long-term capital management?
That was right around the time of LTCM. I don't remember the date, but it was pretty clear because particularly Moody's had published the way they were doing their analysis. And it was, with no disrespect to Moody's, pretty crude. So we said, right now, they're doing something crude. They know it's crude, and they are being very conservative in the way they go about their business in order to cover that concern. But if that level of conservatism were to wane, this could all go bad in a hurry. And apparently, somebody, you know, at the end of 2008, heard about our firm's involvement in the Madoff investigation and started to poke around our website and found this paper I'd written about back in '99 about the ratings issue, which then coincidentally turned out to be a kind of good answer for what would happen in '08. Certainly did I think in '99, oh, wow, you know, 8, 9, 10 years down the road, this is all going to blow up. Of course not.
Right. Now,
That
you
was-
mentioned Madoff.
Yeah,
Your role in
yeah,
the Madoff invest-
that whets
Yep.
the appetite of a lot of our listeners, including me.
Yeah. I mean, I can tell you the story. It's pretty simple. In early 1999, one of our clients, a gentleman named Harry Markopoulos, who had been was a client and his firm was a client. They were in Boston, we were in Boston. They were literally across the street from us, from our offices. He'd also been in a course I taught. Came up, called and said, you know, can I come over and talk to you about something? And Harry and his associate, Neil Cello, came over to my office. And he basically said, I'm getting flack from my business colleagues because I have an investment strategy and it's producing a certain level of return. There's this other investment firm that I won't give you the name of. I'll just call it Manager M. And they assert in writing that they have an almost identical strategy, but their results are a lot better than mine. And so I'm getting criticized by people within my firm saying, why aren't you as good as Manager M? And he basically said, would you please look at the history of Manager M's results and evaluate it and tell me what you think? And the reason he brought this to me specifically was a couple of years prior, I and one of our more junior analysts at the time published a paper in Financial Analyst Journal about mutual fund fraud and funds that purported to have one strategy when they had another. And so we had published the FAJ paper in '97. And so Harry was familiar with that. And so he thought I'd be a good person to ask about this Manager M. And we ran it through the same sort of statistics that we had in the published paper and went back to him the next day and said, gee, the likelihood that Manager M is both real in the sense that the returns they're reporting to their clients are true and also legitimate, in the sense they're not breaking any laws like insider trading or things like that. But the likelihood that they're completely legitimate is 1 in 200,000. And make up, draw your own conclusions from that. So Harry said, should I go to the regulators? And I said, well, I don't know that. I don't even know who this is. Do what you want. So unbeknownst to me, he went to several other friends in the industry and started a full-scale investigation of Madoff and started hiring lawyers to feed regulatory agencies like the SEC information about the case. I didn't hear about it again until December of 2004. Harry came over to our office to attend our holiday party, which Zvi has also attended in the past.
Yes, right.
And Harry had a couple of drinks like we all did. And on his way out the door, going to the elevator, he said, oh, by the way, Manager M was Bernie Madoff. And I said, oh, really? Okay. And I kind of forgot about it again. I didn't think that much of it. I could imagine that, yeah, somebody's cheating. Not a big deal. It happens. So that was at the end of '04. And again, time passed. And then in December, I guess it was early December of '08, the public announcements came out that Bernie had been arrested or turned himself into the police and so forth. And there was this massive fraud. And I thought about it for a couple of days and said, yep, I guess we called that one. And again, I forgot about it. And then that was I think it was a Thursday when they arrested Bernie. And on the following Wednesday, I came out of a meeting and I looked down at my phone and I had 35 voicemails. And that's very unusual for me to even get a couple. So I called our office and said, you know, what's going on? And they said, well, your name's in the Wall Street Journal. Harry, you know, basically gave you the credit for figuring out that Bernie was a crook. And so we've got like TV crews and stuff sitting in front of the office. What do you want us to do? And I spent, you know, several days doing interviews with Fox News and CNN and CNBC and AP. AP was easy because they happened to be in the same office building as we were. But, you know, and basically told them the same story I just told you, that we did nothing out of the ordinary and simply followed a bunch of mathematical procedures that we had published in a journal several years before. And those were available to everybody, and anybody who wanted to see the writing would see it. And so that was kind of my end in involvement with Madoff.
When the congressional committee investigating the thing, did they call you as a witness?
They did not. The congressional committee didn't. The congressional hearings did not call me as a witness. Harry, of course, testified.
Oh, yeah.
The big excitement I got was a call from Sony Pictures saying, you know, we want to could we do a movie about you? You know, sort of, you know, math nerd saves the world, the financial world. And I'm like, no, thank you. And like, so that was the end of that. No, it was an okay experience other than a couple of reporters who were extraordinarily rude. And then life went back to normal. The only follow-up from that really was in 2015, there was a similar incident on a much smaller scale where there was a belief that a particular retirement scheme had some financial irregularities going on. And I got a call from the FBI saying, you know, can we come see you? You know, my first reaction was, what are they arresting me for? And then, you know, after they came and went a couple of times, it became clear that they wanted some advice about an investigation, which went on. And a couple of months later, the object of the investigation came forward, which happened to be the retirement scheme of the transit authority in Boston. There were allegations that the T retirement plan wasn't quite doing the books right. And so again, Harry was enlisted by one of the local newspapers, the Globe, to look at this. And he got me and about another dozen people involved. Zvi, you probably know a couple of those people. At least one of them was from the BU faculty where you spent many years. And so, you know, we all kind of looked at it.
Harry was involved a little bit with BU. I knew him for a long time. Yeah,
absolutely. And, you know, Mark Williams was mixed up in this,
sure,
and a number of people. So,
by the way, going back to the Madoff case, the part that was also intriguing was how dismissive the SEC apparently originally was. And I would have thought that Harry might have them talk to you.
Well, actually, it turns out that it wasn't the SEC written large. Essentially, when Harry first brought this matter to the SEC office in Boston, which is where his office was located and where my office is located, they said, well, Madoff is in New York, so we have no authority down there. We have to send this to Washington, D.C., to headquarters. They will forward it to the New York office. But the people in Boston were very keen to pursue it. They thought something was wrong. They forwarded it to Washington. Washington forwarded it to New York. New York said, we're really busy with a big insider trading case against Goldman Sachs. And we'll get to this when a New York-based client complains.
Mhm.
And until we get a complaint from a New York-based client, we're not going to expend the resources because we're busy with other stuff. And so it went uninvestigated from the standpoint of the SEC in New York. The funny part was when the story broke in the newspapers when Bernie was arrested, the SEC immediately put out a press release saying we didn't know anything about this. And at which point the Wall Street Journal, which had copies of all the documents that Harry had sent to the SEC over the years, said, no, 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 we know you knew. We have the documents. So, so then they retracted the press release and said, nobody senior in the SEC knew about it. So they threw the junior people under the bus and made them take the blame for not moving on this. The only other way I was involved ex post the arrest was I was contacted a couple times by the various law firms that were brought in by the government to try and trace the money as to where it went and how much there was and who had it, things like that. And they did an actually very good job trying to salvage what they could for the investors. And the big problem, of course, was that depending on how you counted it, the total involved was somewhere around 32 to 35 billion, but most of that money never existed. It was returns that Madoff had reported to his clients, profits that never took place because the money had never been invested. It was literally sitting in a checking account. And so of the money that actually went in and the money that actually came out and what Bernie stole, they recovered a fair bit of it and were able to distribute it back to many people. There was one investor in particular who I think had actually asked for a withdrawal of $7 billion and gotten it a short time before the whole thing collapsed. And that investor subsequently passed away, and his family members said, let us keep a couple of $100 million for us and we'll give all the rest back. And you can distribute it to the other investors, which they did. So a fair amount of at least what had actually been invested was recovered.
Yeah.
Certainly not the non-existent profits.
Yeah, right.
Okay, now we're going to shift gears a little bit and get biographical with you.
Okay.
How did you, what forces in your youth led you to this kind of a career?
None whatsoever. I grew up in suburban New Jersey. I attended Cornell as an undergraduate in what was called applied physics, which is really an engineering course. The only thing that made me at all out of the ordinary is I had an unusual hobby, which is that I had played tennis on my high school tennis team, and I had learned along the way to play this weird medieval version of tennis, for which goes back to the 1200s. There are only about 50 courts left in the world. When I went up to Boston from New Jersey or from upstate New York, finished at Cornell, I moved to Boston to learn how to play this weird game. And one of my friends who was local, had attended university in Boston, was a bit depressed because he was having a hard time getting a job. And I said to him, Kevin, I'll prove to you can get a job. I'll go get a job that I don't even want, just to prove to you that it can be done. And I looked through the Boston Globe want ads and found a job that seemed to need somebody with a math background, which was as a junior analyst for a currency trading firm. And it turned out the CEO liked me only because I could give his daughter tennis lessons. And so they offered me the job, and I said, actually, I don't want the job. They thought I was just negotiating for more money, so they offered me more money. And eventually they offered me so much, I took the job. And all of a sudden,
Good
I went
bargaining
from being
strategy.
a physicist.
You didn't
to
even know
being
you'd wanted.
a currency analyst. And some, I mean, the math looked very similar. If you think about option theory, for example, it's a stochastic process that looks a lot like thermodynamics in some ways, a lot like signal processing in electrical engineering. So I could at least, work my way through the math, and did that for a couple of years, went to work for a couple of Wall Street firms, got involved in a startup for a short time, and then started Northfield because I was frustrated because in my relatively short tenure with a couple of Wall Street firms, I wanted to have all these fancy analytical tools, but the cost of renting mainframe computers to actually process the information was prohibitively expensive at the time. This would have been in the mid 80s. And so I said, gee, there's this new thing called the personal computer. You can buy one for about $4,000. Can we, put these kind of systems in those little computers? And so I started calling up friends who had, been in the computer science programs at MIT and at Dartmouth, and said, can we, put these kind of computer programs on these little, PCs? And they said, of course we can. And so I spent a year or two starting to essentially code up, what I wanted to have.
Wait, you had already learned to do some programming.
Yeah, I was pretty, I was a little bit reasonably proficient. And in addition, I was very active in an organization that no longer exists, but was very prominent at the time, called the Boston Computer Society. This was an organization, you could think of it almost like a like AAA, right? You're using your computer and the mouse dies and you don't know what to do. Call us.
Right. I used to be a member of one of the user groups.
Okay.
They had a user group for, I bought an Osborne computer.
Yep.
In
I
about
remember it well.
1981 or two.
Wow.
And, the people at, I was teaching at Brandeis at the time, and the people that were in the computer center at Brandeis, they really had very little familiarity with personal computing, even to the point of connecting a printer and how you get things printed. And it was a whole new area that even regular people good at computing were not all that familiar with.
Yeah, and they had a special interest group on financial computing, which I got involved in, and eventually ended up on their board of directors and that sort of stuff. But we found the resources. Actually, the first employee of Northfield was a guy who had I knew from the industry.
Where did the name Northfield come from?
It actually comes from my explanation of it comes from the Northfield School, which today is still in existence. It's called Northfield Mount Herman. It's a prep school out in Western Mass. But at in early Boston, I guess sometime, I'm going to say early 1800s, right in the area around what is now Quincy Market, there was a pasture, which was called the Northfield. And this was a public pasture where people could graze their cows. And a minister named Moody, established a school on the edge of the Northfield. And what was unique about the Northfield School was that there was no corporal punishment. The children were not beaten. And so this was the first place in America where school policy was you don't hit the children. And so I thought that was kind of a good thing to celebrate, not being violent to children. And that's where the name comes from. And our office to this day is on the waterfront side of what's called Boston's North End. So it's literally walking distance to what had been that pasture.
Great. So you hired a couple of people to
Hired a couple of
work
people.
with the programming and
Yeah, programming, and one of them stayed for a few years, went off to a very successful career in senior management positions at firms like Grantham Mayo and Putnam and Wells Fargo, and then got tired of corporate life and came back and has been back with us for a good number of years. So it is a very small firm, about 30 professionals spread out all over the world. We have people in about a half a dozen countries. But it's a small, very cohesive group. Everybody's been around for a very long time. The sort of staff joke is it's like prison. You get in, you don't get out.
We could characterize, I would characterize it as saying you were one of the early fintech companies.
Yeah, I think that's true. I think the current generation of fintech companies are much more about tech than fin. It's all about, making the screens glossy and, the fewest number of clicks and the most screen time by a user, which is all great because clearly these kind of analytical tools have no value if people don't use them. On the other hand, I have great concern about people putting together fancy websites to help investors or do financial things in ways that aren't really sound in economic terms, that they're oversimplified in order to make it more easily understood or more popular. And you want to make things simple, but not too simple.
What I hear as someone who I definitely am not expert in financial, modern financial technology, but there are enthusiasts who are saying blockchain is the technology that's going to revolutionize the system. What's your attitude about blockchain?
Well, blockchain's really, to me, it's a way of doing record keeping.
Right.
And reducing the costs of financial operations. We have a blockchain expert on staff. He's based in Sydney, Australia, and he's just recently published a peer-reviewed paper on cryptocurrencies based on blockchain. So we have the expertise available internally. What I'll say is I think that where blockchain will be incredibly valuable and where I think it belongs, but it's not a panacea, is one of our early exercises in what you brought up, Zvi, risk management, was one of the world's largest banks who came to us with the following problem. Every day we do foreign exchange transactions. And, we buy and sell currency. And on an average day, $1 billion of those currency transactions have paperwork that doesn't add up properly. I sold you 100 British pounds, but you bought from me 1,000 British pounds. And those transactions that are not accurately recorded go into a special process, which is known as DK, don't know. And this was $1 billion a day. So each day they would try and sort out what were the DKs for the prior day. And they would listen to recorded telephone calls and look at documents and try and figure out who got it right and who got it wrong and who owed who money by virtue of what happened between when this transaction was supposed to occur and when it actually did occur, once it was, correctly recorded. Because obviously the currency values are continuing to fluctuate in between. So depending on who did what to whom, you could make or lose a lot of money. And so the goal was to understand, all right, just out of sheer luck, you're going to win on some of these and lose on others. At the end of the day, how bad could it be? We did this analysis, but clearly carrying $1 billion a day in transactions of indeterminate risk is something for which you've got to allocate a lot of reserves, because you don't know how bad it could get.
Right.
And that's very costly to do. And so blockchain used correctly is a system by which all of those kind of problems shouldn't happen, because while anonymous, the proper recording of all these transactions is a public matter. Everybody can see it out in the open. There's not one copy or two copies belonging to the parties of that transaction. This is public information that has been verified step by step by step by third parties as they've gone along. And that's how the whole crypto thing came about, because you had to give people an incentive to play the role of verifier. You had to give people a reason to want to play on the blockchain, right, and participate in these verification processes. And that's really where cryptocurrencies came from. And then everybody realized, oh, wow, this is anonymous. I could do illegal things or cheat on my taxes or hide money from my spouse. And so it got popular for maybe the wrong reasons. But blockchain, I think, is a great, great, great technology. Will make a lot of financial transfers, simple things. I need some money, I need some foreign currency to go overseas, things like that, will be massive savings, and allow a lot of types of small transactions that are, prohibitively expensive today. I come back from a trip and I end up with 8 British pounds in my pocket. I can't really go to a currency dealer and say, would you please convert my 8 British pounds to dollars? They don't want to do anything under, 500. They don't want to bother with 12 bucks
Right.
worth. I think that's, initially where it's going to be very valuable. The other area where I think it's going to be very valuable is in doing things which are typically not transparent. For example, if a group of people together wanted to pool their money and buy a piece of real estate, today that takes a lot of lawyers and creating partnership contracts and all sorts of other stuff. And once you're in those partnerships, all the legal language of that determines what you can or can't do. Can you sell your share to somebody else and so on? With blockchain and the so-called Ethereum smart contracts, which are really just computer programs that print out a document of a certain type, it's going to be very easy to, get your 50 friends, buy a condo, rent it out, and figure out who gets what share of the profits, and maybe sell your, if I'm a 3% owner of that condo among my group of friends, and I need some cash, I can sell it to another member of the group or to an outsider, literally with the push of a button. I don't need lawyers. I don't need closing documents. I don't need title insurance. I don't need a lot of stuff that, sort of gums up the works in today's financial world.
Yeah, I'm struggling to understand all of that. The concepts like tokenization,
Mm-hmm.
which I know is a big part of this,
Mm-hmm.
but now, as we approach the denouement of our interview,
Mm-hmm.
what about the future for Dan DiBartolomeo? You have shown an interest in the past in playing a role in public life. You were the head of, I think, the Federal Reserve Boston Club, whatever it's
Yeah.
called.
Boston Economic Club.
Right. And you've taught and et cetera. So what's the future?
Well, for right, I mean, I'm very much involved in a lot of industry associations. I like that stuff. I learn a lot from it, both domestically and internationally. I, recently attended a diplomatic reception for the head of the Saudi investment fund in Washington and had a great time. There are a couple things going on. One, I'm still have my day job. And we'll see where that goes. There are a number of companies in the industry that would be interested in acquiring Northfield if I were so inclined. Nobody's made a formal offer yet at a level that I thought was interesting, but that doesn't preclude that happening someday. Continuing to do research and write. You and I actually have a paper that's being worked on.
Yes, we do.
I have probably another 4 or 5 of those in process that will go to either, as textbook chapters or peer review journal articles. That, assuming all those get published, that'll put me somewhere in the low 50s as publications during my career, which for a guy with a day job, I figure is pretty good. And then the only other thing I do is I'm still very active in terms of sports. I still play the weird medieval tennis. I still.
Does it have a name, by the way?
Yeah, it's often referred to as court tennis, as in played by the king's courtiers, or real tennis, as in the Latin for royal, because a lot of medieval kings played. If you look at Shakespeare's Henry V, there's a passage at the end of Act 1 about how the 100 Years' War started, which was, of course, the longest war in Western civilization history. And it started because when Henry got to be king at age 26, one of his French cousins sent him a crate of tennis balls with a letter saying, "Enjoy the tennis balls, don't bother us." And Henry got very insulted by the letter and decided to declare war on France. And I always thought that was Shakespeare being apocryphal, but I actually had opportunity to attend some matches at Hampton Court Palace, the seat of Henry VIII. And I asked the palace staff, was that for real? The thing about the tennis balls with Henry V. They said, "Oh yeah, that was real." Yeah, it's a very
Sounded like a good gift.
Yeah, I don't
Why
think
would
he might
you
have been
take-
tennis balls. I think it was the letter that went with it.
I see.
And which was kind of,
So how is it different from regular tennis?
it's the court's much wider, much longer, so it's a bigger area, and the 4 sides are surrounded by an asymmetrical stone wall that you can actually hit the ball off of. So imagine like tennis and racquetball and squash all combined. You can hit off the walls over the net. And there's some very arcane rules about where the ball has to bounce when and all of this kind of thing. It's very famous in history, both for the 100 Years' War. The other place where it shows up in history is just before the outbreak of the French Revolution. The revolutionaries barricaded the parliament and wouldn't let the parliament, the members of parliament into the chamber. So at the suggestion of one Dr. Guillotine, the parliamentarians moved to a nearby tennis court, which, if nothing else, was big enough for them to all go inside. And they all went into the tennis court and held a meeting about, what is Parliament supposed to be doing at the moment. And the legislation that was passed in that meeting is known as Serment des Jeux de Paume, the oath of the tennis court. And in anger over the fact that the Parliament met anyway, despite having the Parliament chamber blocked, the revolutionaries burned all the tennis courts to the ground. There were about 200 before the French Revolution. I think 3 or 4 survived.
Do you still play regular tennis?
I do occasionally, not often. Once in a while, play squash probably about once a month. So despite being a fat old guy with a desk job, I still play and have remained active in the sport. Northfield is actually a tournament sponsor in court tennis. The U.S. Pro Championships every year are played in Newport, Rhode Island, and we are one of the principal sponsors of the tournament. Players come from all over the world, and we typically will do some sort of corporate event around that activity, which again, Zvi is participating.
Yeah,
in.
I was there for the first time this year.
Yeah, but yeah, it's a lot of fun, neat people, a lot of history, and I guess one of the things about Northfield is the firm's been around now for 35 years with almost no change in what we intended to do or how we go about it. And I don't know whether that's a good thing or a bad thing, but in some ways,
you've certainly grown.
Oh yeah, we've certainly grown. I think we could have grown a lot more had we handled the business differently. But it reminded me a little bit of the medieval tennis, right? I mean, that game is largely unchanged now for about 800 years. They haven't changed the rules or the court structures.
You know what?
So
you know what it reminds me of? Not leaving the sports thing, but your personal story sounds a lot like Bloomberg's story.
Yeah, I've met Mike a couple of times, and certainly, I think there's a funny, story very briefly. At one point, one of the analytical people at Bloomberg said, "Oh, we should go out and acquire Northfield." And so they came over and said, "Can we buy you?" And I said, "Why would you want to?" And the answer was pretty funny. They said, "You have a very strong corporate culture within your staff. It's not like the Bloomberg corporate culture, but it's clearly, very well defined." And I said, "What do you mean?" And one of the people in the room, I won't mention who it was, but very, very well known in the area of risk management, said, "We think it's a cult, and we're okay with that." But we're okay with that. And I am like, all right, fine by me. And that nothing ever happened. Although I did have lunch with that one gentleman who spoke about the cult idea probably a couple of weeks ago. So we're all still in touch. We're all still around. And so far, so good.
Great. Well, thank you so much, Dan. This has been a unique, more or less unique. Actually, you know what? I see a connection between this interview and our interview of Allison Schrager, who is a expert on risk.
Mm-hmm.
And did you ever meet Allison?
Not that I recall.
Oh, okay. She's got a book which is selling pretty well called "An Economist Walks into a Brothel."
Okay.
And it's all about risk management in among
Sex workers.
in the industry of sex workers in Nevada.
Mm-hmm.
So
I wouldn't doubt it. One of the, if you think about it, that's not an entirely new idea. If you think about all the statistics we do today, everything we do in statistics is really based on the ideas of conditional probability.
Right.
And the first researcher to get the math of conditional probability about right was an Italian doctor named Girolamo Cardano. And Cardano wanted to use this to cheat at cards. He didn't care about anything else. He wanted to, he was a gambler.
Right.
And the funny part
was in the 1500s, right?
Yeah, 1600s. His book was published in 1663. But the funny part was that he was a bad gambler and he lost a lot. And so he had to finance his gambling habit through his day job. and he was a doctor. And so in order to earn enough money to support his gambling habit, he invented a bogus cure for syphilis. And so he was a fraud.
That's the connection. I wonder if Allison knows about this.
Yeah, but if you look up Cardano's life in detail, his book was called The Book on Games of Chance. And it's basically how he cheated cards.
Right.
But he got the math of conditional probability right. And but what most people don't know is that he was a doctor, and he'd actually done what had passed for legitimate medical research on smallpox.
Wow.
And so he was well known. And then when he got desperate for money, he came up with this bogus cure for syphilis and killed I don't know how many people with a false cure. Of course, there wasn't a real cure for a couple of 100 years because you needed antibiotics, which certainly did not exist in the 1630s.
Interesting. I wonder if the Bernoulli family built their studies of probability on, because they came 100 years later.
Yeah.
Or roughly
100 years. Yeah. Bernoulli's early 1700s, Cardano's early 1600s. So although the book didn't come out till 1663, he was dead already by the time the book was printed.
Okay, on that happy note.
Thank you very much, Dan. We all learned a lot. The Madoff story was especially interesting, as well as how you got into your field. And some of our listeners may learn your lesson about getting a job that you might not care to do, and how much bargaining power that gives you.
My life has been a lot of random events, so I spent a lot of time studying random events and understanding how important they are. I think I'm probably paraphrasing some poet or songwriter, but I think when we look back at our lives, we think of, spend half the time thinking about what might have been and the other half thinking just as well it worked out the way it did. So I think we're fine. But gentlemen, I thank you for your time. I hope this was valuable for you.
Very valuable.
And your audience.
Thank you.
Have a good one, guys.
We always end our interviews with the saying "Sei gesund," which is both German and Yiddish, and it means be well.
So,
thank you, sir. All right. Be well. Bye-bye now.
Bye-bye.